Thanks to everybody who has filled out the questionnaire. This is really helpful in order to get a snapshot of what the community is thinking. So we had a number of questions. Classic to 361, what scares you and what excites? There is a wide variety of answers for each one of these categories, and I attempted to compress them down into just a few that captured the spirit of each question. Interesting enough, and unfortunately, there were a lot of responses that essentially was Armageddon. Just so many banana peels out there that could have tremendously negative impacts on the world and the economies that we're facing. So that was one. The Fed activity, principally over tightening, going a little bit too long, inflation and rates kind of getting out of control, volatility that we've all experienced for a while now, and then China, the big question. And yes, is it investable or is it like non-investable? And that's a very interesting question that we could do for a long time. On the positive side, there are a wide number of responses that just things are getting better. Valuations have come down, metrics have come down, things just look a lot more attractive. Chris, you'll be happy to know that oil and gas was mentioned and distressed, as well as innovation plays in private equity and venture capital. In terms of most attractive, there was a long list. There really wasn't a lot of commonality among what people were responding. So I just picked out a couple that were unique. One was diamonds and gems. I haven't seen that in the survey since we've been running this since March. The metaverse, lingering back there, sort of crypto aside, and then just attractive pricing. Again, things have come down. So there are more opportunities out there. Least attractive, crypto, supply chain dependent things, and tech. It's kind of interesting if you had a look into the individual responses, you could see what is one person's passion is another's poison. So it's fascinating to see how people are looking at things and seeing different facets of it. Yes.
I just want to point out that even you
don't have the you don't know the names.
No.
So we're keeping this all on an anonymous basis.
Right. So you don't have to be afraid of me calling you out. But I did see the responses. So then we asked a couple of questions in terms of what the feeling is as far as, various metrics, if you will, sort of global recession. And we said, yes, no, or maybe. And when you did a weighted average of the responses, it came out to sort of maybe, but leaning towards yes. So people are more inclined to believe that a global recession is coming than not. On the US side, it's a little slightly more favorable in the sense that it came out with a solid maybe, as opposed to really being one way or another. And well, obviously, there were people's responses were in those categories, but again, when you average them out, that's what you're kind of coming out with, things that are in the middle, sense maybe sort of showing up both times. And then looking at Fed funds as a possible target at 4.5%. Is this yes, a little higher, a little lower? On average, people generally tend to feel as though that the Fed's going to wind up about 4.5, which actually, if you look at their dot plot, that's about where it is right now. Although the OIS curve is actually showing it a little higher, around 5% early next year. So we'll see what happens.
And that was March 31st. That was the
right.
time.
Yeah. So this is, yes, looking out to March 31st, where are these numbers going to be? With regard to the 10-year, first quarter next year, 4% or higher. That was, again, kind of pegging it at 4%. Was it going to be higher? Was it going to be lower? Or was it going to be right at 4%? It turned out to be pretty much at 4%, but just there were enough responses saying that it would be higher that we just moved it forward a little bit. Inflation in the first half, written in green, sort of at or lower than current levels. So this is sort of a shift in opinion because the previous polls that we've had, people were definitely expecting higher inflation moving forward. Right now, I think the consensus, what we can draw out of the responses is that inflation may be peaking here in the US. Certainly hope so. More tactical or more strategic, or just kind of maintaining and rebalancing as the markets, come and go to us. That was where it was, pretty much in the middle. So previously we had folks moving more tactically in the responses over the last number of months, but now it seems as though that they're pretty much maintaining. The other part of the questionnaire was looking at asset allocation numbers in terms of, what percentage of your portfolio is allocated into the asset classes noted below: public equity, public fixed income, VC, private equity, private credit, real estate, hedge funds, commodities, gold and precious metals, crypto, cash, and other. So you can see this is on the whisker chart. The box gives you essentially the 25% to 75% range. You can see the X's are the medians, and either the dot or the top of the whisker is the highest response in each one of those categories. So you can see that overall, public equity actually occupies a pretty big piece of most portfolios on average. And then actually followed up by real estate and then cash. You can see just there are really, the larger ones. Interestingly enough, fixed income, VC, PE, and private credit, all, roughly about the same on average. So again, the interesting thing when you're looking at the actual data, you're finding a lot of responses or barbells. That people have a lot of allocation in one asset class or another, or maybe two or three, and then nothing in the others. But when you take the community response all together, this is kind of what you get. It's a little bit more homogenized, if you will. Then I was fortunate enough to come across a larger survey of family offices, and that information is noted in the blue bars. There's over 140 responses in that data, and I plotted that relative to the mean allocation. So that would be like the X's of the previous. Go back. There we go. Fairly contemporaneous. There is a little bit of time lag between the two, but I don't think it's enough to make that much of a difference. So you can see the means are there in the X's, and then there it's reflected in the bars for the 361 community. I thought this was really interesting in the sense that on average, the community doesn't look that much different from a much broader sample of other family offices across North America. In particular, there's a little bit higher public, even more higher public equity in the larger sample, higher private equity. I thought it was interesting that the venture capital allocation was a little bit smaller. I'm not sure if that is how people are reading venture capital versus private equity. So, maybe there's some characterization there that would bring those bars closer together. And then, of course, real estate always, but consistent across both 361 and the other family offices is that hedge funds. And, I think people I've been in the business a long time, used to work for a lot of hedge funds, has really, the luster has come off there, not for good reason. So, but not a lot, going on there. So is that it? That's it. So there are the summary. Again, thank you for everyone who filled it out. And if you haven't, go to the link.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.